Hello everyone, today is Friday, May 13th, and this is your USA Gold Weekly Review and Outlook. Choppy week in gold, kind of consolidative in tone is how I would put it. Went down and tested that 1265 level, came up off it, came back down on it, up about $5 on the day today, right around 1270. Silver really similar, pulled back to the $17 level, which is the other kind of major correlated support to the 1265 level in gold. And so it kind of pulled back to 17, dipped a few cents below it, and right now hanging right around that $17 level. But all in all, Pete, pretty stable considering, right?
Yeah, pretty steady, corrective, consolidative tone within the broader uptrend that commenced to start the year. And so a lot of interesting things with respect to that. We got the World Gold Council's demand report for the first quarter. Showed very robust demand, 20% rise in gold demand in the first quarter. That was the best first quarter on record. And perhaps not surprisingly, when you look at the price movement over the first quarter, we saw about a 17% rise in prices during that time period. That was the best price performance in the first quarter in 30 years.
Yeah, so all tied together, and and also, just on the week, and this is what's starting to happen, as I think it's an evidence of what you're saying, is that you had what would arguably be some negative stuff for gold this week, or what at least formerly would have been, largely negative. You have dollar strengthening, some decent numbers, and then, gold actually kind of held its head,
Yeah, and in fact, it's doing that today on Friday. We had a really good retail sales report. Beat expectations, came in at plus 1.3% in April. Expectations were running around plus 0.8%. So one would anticipate, we saw, some ratcheting higher of Q2 GDP expectations on that number, but interestingly, the dollar was the only one that seemed to react positively to the news. We saw, stocks remain under modest pressure at this point. The bond market remains elevated, and gold is trading higher on the day, kind of despite all those factors.
Yeah, kind of inversely to the dollar, which you're right, it is unusual. Generally speaking, they're highly correlated, gold and the dollar, that is. And so when the dollar is having a strengthening phase here and gold holds its head, it bodes well for when that reverses. And I think the stronger correlation is when the dollar falls and gold rises. But when the dollar is rising and gold doesn't fall as much, it just bodes well, and it speaks to the demand idea, which, let's get back to that a little bit, because it is pretty remarkable what has occurred. It's central bank demand, it's ETF investor demand. It's rampant and pervasive through the entire market. Demand's up in India, demand continues to be strong in China. It's global. This is a paradigm shift.
Yeah, and the investor demand number was quite shocking. It was a 122% rise from a year ago.
It's incredible. Yeah. In a year ago, prices were, low then, relatively and arguably as well. And actually, at the beginning of last year, we had a nice rally as well. So, technically, it would have been a tough year to beat, is maybe what I'm saying, because there was a similar situation. People thought maybe the low was in it. It didn't end up being that way. And now this year, we're seeing similar patterns of trading and better stability at these higher prices than we did last year thus far. And perhaps that's contributing to it as well.
And that may be the big takeaway. It is, in my opinion, very much a confirmation that the low is in place.
Yeah, it looks that way for sure. And so, and we're not the only ones who feel that way. But this whole demand element and what has changed, it's a fascinating development for gold, and it does show or highlight the shift that we've been talking about and that we have seen. And so it's dynamic, to say the least.
Yeah, and you're right. A lot of people did kind of weigh in on the bullish side this week. Even Goldman, who has been pretty historically bearish, they remain bearish, but they kind of upped their projections after getting stopped out.
They're getting clipped pretty hard. Yeah, for sure. And that will be covered in our Golden Gong here shortly. But first, something in we try to keep you apprised of what we call forward-looking situations, if you will. And here we're about a month out from the vote in Britain on the Brexit. And want to talk about that a little bit today, just because that is a big deal, frankly, and what's going to happen and what does that really mean. Europe collectively is third largest economy in the world. Britain's a big part of that. Kind of the notion that they want to leave and that they're going to have a vote to leave. And if they do leave, what's that going to mean for the euro or for the European Union?
I think it's probably going to be a negative. I mean, there are a lot of unknowns with respect to that, and that's probably the last thing the global market needs right now is a new unknown. And the BOE, Bank of England, came out with kind of an opinion on that yesterday, and they were very pessimistic that if the UK chooses to leave the European Union, it could very well lead to recession. So they were anticipating weaker economic growth, investors pulling back in advance of the vote. So it was not very encouraging at all.
Yeah. Well, and what I thought is interesting too, and I had read this, that and you actually notified me that they used to do the polls, but the polls basically say that about 60% of the citizens that live in the European Union want their respective countries to leave the European Union, and it's an indictment of what they're doing there and what kind of a life it's led to. And we've covered this over the years and everything about how the smaller countries, the BRICS nations, right? Isn't that what they call them, the BRICS nations? That have really been penalized by the whole debt structure and the stronger currency. They used to always be able to devalue their currencies. Greece is an ultimate example of that, where whenever they got in trouble, they would devalue their currency, bump up their tourism economy, and kind of muddle through. They don't really have that luxury anymore, and so these countries are under a great deal of economic duress as a result of that. And so to see England, who is technically one of the stronger, I mean, not technically, it is one of the stronger countries of the European Union, right there with Germany, to be thinking about leaving, it is a pretty profound indictment of the European Union and of the economic impact of this union.
Right, yeah, and so with respect to votes within the UK, it's pretty evenly split right now, so I think it could go either way. It kind of swayed a little bit in favor of staying following President Obama's weighing in on the matter.
Right.
I'm guessing that the Bank of England's dire warnings probably swayed things maybe a little bit further, but the polling remains pretty evenly split.
Yeah, and regardless of the outcome, it's going to be something that we want to watch and that we're going to be keeping our eye on, because it's exactly like Pete said. It's more what it means to the stability of the European Union and these general takeaways of that we're even getting to this point there, and what does that mean for the world economy? We can't really take a lot more bad news, and I think that's the point and the real takeaway from all of this is we're kind of in a fragile place already, and you're seeing that kind of in equity values and the economy as a whole, and so to have this looming over it is just another log in the fire, if you will.
Yeah.
So with that said, now on to the golden gong, which I actually am inclined to call it the golden moment of silence, because I'm just amazed, and I almost need to take a minute to digest that this happened. And if you've been following our blog, you probably know what I'm referring to, but it basically is Salita Marcelli, who's the global head of fixed income for none other than JP Morgan, came out with a ringing endorsement of gold. And not only that, did so with what I consider to be the proper fundamental argument for it. And so it wasn't just this crazy speculative price-based notion of, oh, we've got momentum, therefore trade it and jump on board. It was very well grounded and very sound in its reasoning. And so, yeah, moment of silence, golden gong. Either way, we'll call it the golden gong today, but here it goes. Salita Marcelli. We're recommending our clients to position for a new and very long bull market for gold. $1,400 is very much in the cards this year. Central banks may consider diversifying their reserves as they anticipate negative rates on existing holdings. Gold is a great portfolio hedge in an environment where the world government bonds are yielding at historically low levels. Gold is looking more and more attractive every single day. As a non-yielding asset, it has a minimal storage cost, so when you compare it to negative yielding assets, it actually has a positive carry. And that last point is such a good one that we've been saying for a long time, because one of the big criticisms of gold over the years has been that it doesn't yield anything, but in a world of no yield, it actually does. Mm-hmm. Ironic and true. Thank you very much, Salita Marcelli. To you, the golden gong. Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Grant.
See you next week.